Welcome to the daily update where I'll go over the action in the market for Wednesday, June 25th, and we'll see how things look for Thursday, June 26th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Pretty much an unchanged day. We were down a few points. On a percentage basis, it comes up zeros, so it's technically considered to be a down day. But it was really the mega caps and semiconductors that held things together. If they hadn't been up, the declines could have been more severe. And that's what we've been seeing kind of off and on over the last few weeks. The growth to value ratios are holding up. The semiconductors are doing better than the tech sector, which the tech sector is also doing pretty good right now. So we are seeing some improvements. We have the NASDAQ 100 generating a golden cross. We're getting closer day by day with the S&P 500, but there just wasn't an awful lot of conviction. The smart money didn't really come in and drive the market later on in the day. So right at the open, we did have a higher open. It wasn't a gap. We just opened up higher, and we were slightly below R1 right at the open at 6110. So we were above the 6100 level. But that set the intraday high right there. We weren't able to break out and build upon that. And prices just kind of drift back down. They drifted lower and came down to the unchanged level and to the daily pivot at 6,084. So now we're back under that 6,100 level. Then we just chopped sideways. But we were above the daily pivot, but then we pretty much closed unchanged. So we were down 1 or 2 points with the S&P. So that's why there's a minus sign here. But from a percentage basis, unchanged. We're back to below average with volume. Now we do have some important economic reports coming out on Thursday. There was really nothing said that was monumental with the second day of Chair Powell's testimony before Congress. Things seem a little bit kind of slowing down, not really developing as far as between Israel and Iran. You have the president off talking to NATO. That's kind of taking the headlines right now that they're agreeing to pay more into the whole organization there. But we are still positive. When we look at the short, intermediate, and long term, we're still above the 20, 50, and 200 period moving averages. That hasn't changed. And a lot of this consolidation that we've seen over the last few weeks, even though we tend to drift a little more negative at times, all of this has happened above the 20 period moving average. And so that means the market's holding up for right now, but we're still not trending. Now, the short term, we're trying to show some kind of a trend, but we're not there at the intermediate term. And that's what I focus on. I kind of hub everything around the intermediate term trend. Interest rates ticked down just a notch. It was a pretty slow day in the bond market as well. So here's some comments. Fed Chair Powell didn't say anything that was all that different, and that's typical. He makes the same statement because on Tuesday he appears before the House, and then on Wednesday he appears before the Senate. The committees and his prepared remarks are pretty much the same each day. So we're hearing it for the first time on Tuesday. It's just a repeat on Wednesday. It's the questions and answers that come later. That's where they try to get something that makes some news, but nothing really happened there. NATO confirmed its commitment to a 5% defense spending target, which it's like, okay, this, on one hand, people say this should have been done a long time ago. Other people are saying, oh no, this is going to destroy Europe and destroy all the economies in Europe. Well, okay, you kind of have to decide what's more important with that. But that was taken as positive. There were no real developments. Now, this could change at any time in the whole Israel-Iran situation there, and then the U.S. involvement or non-involvement with that whole thing. And what kept the market together were the mega caps and the semiconductors. They actually had some advances there, but the rest of the market was actually more negative. Oil, and we're getting back down at least to a little bit more normal range. We're at 64.88, and it was up, but like 40 cents, maybe a little bit more than that. The NASDAQ did close at a new all-time high. And excuse me, and these are the mega caps. These are the semiconductors. These are the really big stocks that really drive the market higher. And so it was up on the day. And then on a short-term basis, the Stochk RSI is improving, but it's not on the list yet. Where we have the Williams percent R, CCI 14 and 20, and then the stochastics, they're improving, but the long-term chart is still negative. So we're seeing some kind of good momentum in the short term that's looking more positive, but it's not really across the board there. We're still having a difficult time with our oscillators, both short and intermediate term, with them turning back. It takes a little bit longer, even with our short-term oscillators. Price really has to move to see the oscillator itself move, and we're still far away from the 20-period moving average. Intermediate term, we still have that rate of change going back 50 periods that's giving extreme readings. And the PMO is still below its moving average, but still extreme positive, as are some of the other momentum indicators, but they're still pretty much negative. They're showing some improvements, but they haven't switched over to positive. The Sean trend meter is up in that initial area where it's positive. If it goes up into the next area above, that's when it's looking more extreme positive. But I start watching it when it's up in that green area. We're also far away from the NASDAQ, excuse me, from the 50-period moving average, and the NASDAQ 100 bullish percent index is right at 70 right now. That's the extreme level there. No change to the scenario. The Fed is concerned of economic slowdown and inflation pickup. And then the dollar decline, it's continuing to go down. We're into the 97 range again, and that's what's been helping stocks as well because of the conversion rates and import-export relationships. A weaker dollar actually helps the earnings look better for companies. Interest rates ticked down. They were at 4.3%. We ticked down to 4.29%. Sentiment is still positive. We're at 59. We actually ticked up a few notches there. We're not trending, at least in the intermediate term. We're trying to start to develop a trend in the short term. And then this is strange. Usually the bias is either up or positive or negative since we were virtually unchanged. We looked more negative under the surface, but the fact that we were unchanged on a percentage basis, I'm keeping the bias, or I changed the bias to mixed right here, and I'm keeping the momentum at mixed because we're getting a lot of mixed signals. There's just not a lot of conviction in the market. All right, we did get new home sales, which were down 13.7% on a month-over-month basis. When you annualize that, that's 623,000 units. They expected it to be annualized out to 700,000. And the last time we had the report, it was at 722,000. So we're still seeing some weakness there with home sales. On a year-over-year basis, we're down 6.3%. Then every week we get the MBA Mortgage Applications Index. It was up 1.1% week over week, with refinance applications up 3%, but purchase applications were down 0.4%. All right, so here are the mortgage applications, up slightly after in the previous week we were down. Then new home sales, this is annualized here, where it's coming down, but we've been in this range now for quite some time. We're just coming down into the lower end of the more recent range. And then the prices, a 3-month average, they still continue to go up. And you get these houses that are increasing in value, but you have interest rates higher than they were before, and it's pricing a lot of folks out of the ability to buy a new home. And you might be able to sell your old home and get a really nice price for that, but are you able to buy a new home? You have to be in quite a favorable condition for that to be able to happen. Okay, so here we have real investment advice, and this is historical. This is just what do oil prices do, and then different historical events that have happened along the way. And we haven't seen a real big spike up lately. It really went up when the whole Russia-Ukraine thing first broke out and then ended up drifting lower than that. But Oil seems to be relatively calm. There is this fear that Iran may shut down the Strait of Hormuz, but that really doesn't affect the U.S. all that much. It's mainly China and other countries that get their oil from that path that it needs to go to. And so it doesn't seem to be as viable of a tactic if Iran wants to go ahead and shut that down. Okay, then if we're higher in May and June, which we still have a few days left, but we're up 2% so far on the week anyway, and we'll see if we can end up having a positive June close anyway. That'll be on Monday, and that's the last day of the quarter and the last day of the month. So that it could be kind of a wild day on Monday when you have window dressing and readjustments and things like that. But if we do end up having a positive June, we've already had a positive May. The rest of the year does very well, and this is put out by Carson, showing that the average return is 1.3% here, and we're up 60% of the time. But the further out you go, we get a little bit better with the percentages, both with the win rate and with the return rate there. Then we've seen a real decoupling of this. I don't know if it's drones that are delivering things now or what, but ever since the COVID crash, you see the truck tonnage index, which is the gold line here. It usually sticks pretty close with what the S&P is doing, but they've really deviated from each other now. And the transports, the Dow transports still are really struggling. And that's kind of also borne out here in the truck tonnage index. Then the announced buybacks and then the actual buybacks done here. They usually announce more than what actually ends up happening, but they are going up. Even though the announcements are coming down a little bit, the green line, which are the actual buybacks, are continuing to go up. And that's seen as something positive for the market. Discretionary versus systematic strategies. I try to explain this every time. We're discretionary. You can pick and choose, decide when to get in, when to get out. Or a systematic approach, you don't really care what's going on in the market. You're just adding to a system, maybe through dollar cost averaging every month, with the idea that when we're going down, your dollars are buying more, and then that benefits because most of the time the stock market is going up, about 70% of the time historically. And so they're starting to match up with each other a little bit as we've been coming up out of the April lows. The blue line, which is the systematic approach, it's been improving. And then you have folks that are with the light green line here saying, okay, let's wait for a good time to get in. And there's some FOMO going on here, but they're not seeing an awful lot of confidence in the market right now as we get set to go into the summer months. Then financial conditions indexes, we've been coming down with this lately. We've been seeing weaker than expected economic reports, and this coming down, it could be seen as somewhat negative right now because even though we're coming down and it's loosening a little bit, that usually gives some support to the market. And we're seeing it. The market's still maintaining more of a positive stance for right now, but it would be more positive if this continues to go down. And then the NASDAQ 100 is posted as the highest annualized risk-adjusted return year to date. It's the strongest index right now. Over here on the left, the NASDAQ 100, followed by the S&P. And then you have the equal weight, which is the rest of the S&P that's lagging a bit there. And then the S&P 400, those are the mid caps. And then the small caps are the Russell 2000, and they're still struggling here. And then the market implied equity risk premiums have been coming down a little bit here, and it reflects a market where investors earn little to no additional expected return for taking on the higher risk of actually owning stocks, where bonds are considered to be safe. You're locked in there. Yeah, there's interest rate of adjustments and economic adjustments that can hit you that way, but investors typically anticipate being compensated more for stocks because they are a lot more volatile. Then stocks head for record amid tumultuous year. Okay, we're not there yet. We started less than 1% above the all-time high in Wednesday's session, and we closed less than 1% from all-time highs. We're not seeing a lot of enthusiasm right now, trying to get back to this previous all-time high here. Then money flow in the G4 central bank asset purchases These are just the different central banks. And we're seeing some decreasing going on here. This is a 6-month average. And then I did run across this chart. This isn't from Isabel Net, but this is put out by Lance Roberts, who is with Real Investment Advice. And this is why we're probably seeing the skew index giving us a pretty high reading right now. You can see just a massive amount of calls. Calls are options where you buy something and it's usually quite a bit less than buying the outright instrument itself. And you benefit if the S&P or whatever you're buying calls on actually ends up going up. And Lance says here, the S&P call option volume has become completely unhinged. While the speculation is currently working, which draws more investors into the scheme, because usually when you're first starting out in the markets, you probably are involved in options. I do a lot of option strategies and I teach them in the program that I have, and we use them quite heavily. But these are usually the less informed. I mean, I think they really know what they're doing. They can read Options for Dummies over the weekend and say, now I'm an expert." But it's a lot more complicated game than that. So this draws more people in. Hey, buying calls are the cool thing to do. But as he said, this will eventually have very bad outcomes because a lot of times folks they're using emotions. They're using, excuse me, they're using hunches. They're just thinking, oh, come on, baby, I just have a good feeling about this. And then it ends up not working out. But it'll work out just enough. And you might have one or two or a few successful positions that you get into thinking, hey, I'm really on to something here. But over the long term, it's a lot more difficult. That's why I look at so many charts. That's why my videos are longer. It's what you don't know that can really kill you in the market. And people just use one or two little indicators, or they go off a hunch or a recommendation from somebody else and think, oh, this is the way it goes. Or they're in a chat room or something like that. And it might work, and you might even have a successful win rate. But when you get killed bad. All right. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. So here is the chart. Higher open, set the high right at the open, drifted down here to the daily pivot. We stayed above the daily pivot, tried to go a little bit positive later in the day, but then dropped back down and ended up being unchanged on the day there. And we saw most of the strength coming in right as we were opening in the market and then dropping back, and we're pretty flat right now. Still looking okay here with our intraday growth to value chart. The blue line is still above the red line. Still, and this is improving. We saw growth have a good day compared to value, and so this ratio is continuing to go up. So our end of day charts were actually showing a little bit of improvement. Growth was up where value was down. And growth was down, but down less for the mid caps, but down more for the small caps. So we look at the small cap growth to value ratio, still holding up, looking fairly well, even though the index is not really going anywhere. And we're breaking out, setting a new high with this ratio with mid cap growth to value, but the index is not going anywhere. And this is improving. We have seen a recent golden cross with the S&P growth to value ratio, and we're coming back up, but we're still fairly range bound here. We haven't really broken out above this previous high set back in February. And we did see an improvement here with this growth to value ratio, but again, we've been chopping a lot sideways. So if we have a down day, it's probably not surprising if we come back down into this range. If we do get more conviction to the upside, then this ratio would continue to go up. And the large cap growth ETF hanging out above the moving averages here, seeing a recent golden cross, improving, but not back to an all-time high, at least yet. And then discretionary to staples, not showing any real strength here, but still hanging out above the 200-day moving average when we look at the discretionary to staples ratio. And this is an inverse kind of what we were just looking at. This is value to tech, which is growth. This ratio going down, that is positive. That just means that tech is outperforming, and that's what we want in a more positive environment. And here's where we're trying to come above the moving average with the short-term ADX, but we're still below 20. The green line's on top, so we still default to positive, where we're still right about at the moving average with the intermediate term trend indicator, but it is also still positive, but it's also still below 20. And we're dropping back down to below average with volume. After seeing a few days above average, we drifted down below average. And we're dropping with the VIX. We're below 20 and declining. That's more positive for the market. And the VIX of the VIX continues to drop as well. We're rolling over here. The momentum is still positive as measured by the MACD, but with the last few trading days, with the VIX coming down, that's rolling the MACD over as far as the momentum. We're still up in this red area, probably because of that call option chart that I showed a few slides ago. That's why we're getting pretty high readings now with the skew index, because a lot of times what folks do is when they buy, let's say, call options because they think things are going to go up, they don't buy options that actually have any worth right now other than time value. If the S&P is at 600, they might buy a 650 call. That's out of the money at that point. And when there's a lot of that activity going on, because those 650 call options are a lot cheaper, but they're like lottery tickets too. I mean, when you win big, but the odds of winning can really be substantial. Plus, you're also dealing substantially less. Plus, you're also dealing with time factors. The options only last for a certain period of time. And you might be right about what you think the market is going to do. You just weren't right as far as the timing. It happened after your call option ended up expiring. Okay, and we ticked up a little bit with this fear gauge, and we ticked up with this other fear gauge. So even though the fear and greed index that we saw ticked up, we're also ticking up a little bit here as more as fear. So a bit of a contradiction there. And this is also encouraging. The risk on to risk off ratio continues to go up, and that's more positive. Folks are still willing to get into stocks, and most of the stocks that we're seeing favor, at least in Wednesday's session, were the big stocks. And this is also showing that the big stocks are showing more favor. The high beta, that's Apple, Amazon, Google, Netflix, this continues to go up, and that is a positive thing. We declined on the daily chart of the equity put call ratio. We're going back down after really coming up here with the 5-day chart and the 10-day chart sideways to slightly declining. Coming down, but still above the band here with the volatility risk premium. And then the advanced decline lines holding up. We declined both based on price and volume, but we're still well above advancing moving averages. We're back below zero with the 10-day advanced decline ratio, oscillator here. We were above zero. Now we've dropped that back down to below zero. So it was the big stocks that held things up. The rest of the S&P, that's seeing a little bit more weakness. And we declined a little bit, but still above zero with the short and intermediate term advanced decline ratio. Improving with the new highs. We did set quite a bit more new highs than new lows, and we're seeing a general shift with more green rising up here with the histogram. So that's turning the 5-day back up. It hasn't quite crossed positive yet. Slightly turning up here with the 10-day moving average of the new highs minus the new lows. We're still positive even though it declined, depleted. We're coming still above the red line here with the accumulation distribution. We rolled over a bit with the boom indicator, but we're still above the moving average. And we're back to negative again with the Chaikin money flow. The histogram dropped and the red line is now starting to go down. We're still positive though with the Chaikin oscillator. It continues to go up and it's above its moving average. So we're getting now a mixed picture with our smart money indicators. The vortex continues to be positive with the green line above the red line. We're still above all the moving averages with all the different indexes that we follow with the advanced decline line studies. I haven't shown this in a few days here. The 5-period moving average of the highs and lows across the broad market, still above zero, even though it has been coming down slightly. And we're still above 50, even though we declined with those stocks in the S&P above their 20-period moving average. And still positive with the 50, 100, and 200 period moving average study, even though all of these charts declined on Wednesday. So we're looking a little better here. We were able to get above this pivot point here for June Now we're starting to see the July pivot points come into play. And even though it was a down day and we haven't set an all-time high, we're getting pretty close here. But it's kind of strange that we're so close to this previous all-time high and we see kind of a boring day. And we're getting close to a golden cross with the S&P, but we're not quite there. And we are below average with volume. So we declined, but still above 50 with the 20, 50, and 200 period moving averages on the S&P. This is the Stochk RSI. It's giving us a high reading, but it hasn't crossed above this 0.8 level yet. That's where it starts to show more solid short-term momentum. But we are there with the Williams percent R, the CCI 14, and the CCI 20. The short-term stochastic coming down a little bit, but still extreme positive, showing good short-term momentum. Intermediate short-term momentum is positive, improving and extreme positive here with the long-term, but we're still above, we're still below the moving average. Still positive and above the midpoint with the force index, improving with the short-term trend. We're above both of the lines and the lines are continuing to go up. We're still up at the high end of the +2 channel with the standard deviations chart. Balance of power still above zero. That is positive. Still above the short-term 10-period simple moving average, the fluorescent green one here, and it's starting to go back up. So that's still hanging on to being positive. We're positive with the go, no go with the darker blue bars. We're still at the high end of the highest high value. So that's positive. The Landry light still has a positive trend, a green histogram that just gets bigger and bigger the longer it lasts. And the same thing here with the proper order. It is continuing to be positive. We saw a little bit of a switch here back to positive with the TTM squeeze. We were a little bit concerned because it was turning darker blue and declining. Now it's lighter blue and actually advanced. And here's the rate of change going back 50 periods, still giving us a very high reading there. Just skating along slightly above zero with the ease of movement. And the Arun continues to be positive with the oscillator above zero and advancing. Then we switch back to negative again with the McClellan oscillator. So it was the big stocks had a good day, but the rest of the stocks in the S&P didn't. So we're dropping down below zero with the McClellan oscillator. Can't see it, but we're technically declining now with the summation index based on price. But we're still going up based on volume. So a bit of a mixed picture there. We also dropped below zero with the NYSE McClellan oscillator. So can't see it, but we're ticking down with the summation index based on price and volume for the NYSE summation indexes. Excuse me. But the swirling trading oscillator, positive, above zero and advancing. And trying to turn up, it's still below the moving average of the PMO, and we're still above this red line, which is giving us an extreme positive reading. We're improving, but still negative based on price, where we're trying to cross back above the moving average based on volume. So we're seeing volume doing better than price right now, which could be positive. And we declined. We're slightly below 50 with the PMOs that are rising. We ticked back down just a little bit after we had been improving with the buy signals and ticking down just a little bit here with the PMOs that are above zero. Still positive with the Elder's Impulse system for the S&P. Still positive with the Parabolic SAR for the second day now. And just kind of meandering around trying to turn up here, but still right at the green line and slightly below its moving average with the slope oscillator. Improving, but still negative with the MACD. So you can see the slope just kind of chopping along sideways. Seeing a bit more of an improvement with the other short-term oscillator. The TSI improving, but still negative with our three intermediate term oscillators and still negative with the long-term oscillators, the TRIX and KST. Still negative with the Copic Curve momentum oscillator and flat, but in this green area here with the Sean trend meter. Still above 50 with the money flow and with the ultimate oscillator. Still above the moving average with on-balance volume. Still above 50 with the RSI charts. And still looking good here from the intermediate term. We're back up to this red line here, and the red line's continuing to go up. We use the blue line as support, and that continues to go up since price is above both of these lines, especially the blue one. And still above all the plotted moving averages. Still far away from the 20 period and 50 period moving averages, though. That because price has a tendency to snap back to the moving average. We're still positive with the bullish percent index. We saw enough of an uptick Even though it was unchanged, we're still above the moving average and just kind of floundering around a bit, but still positive since it's above 50 with the NYSE bullish percent index and right back up to 70 with the NASDAQ 100 bullish percent index. So still looking okay. This is the weekly chart. We still have a series of higher highs. Now we don't know. We have 2 trading days left if we're going to end up being positive, but we are up over 2% so far for the week. And we're still positive with the Heiken Ashi chart. We're positive with the Kagi chart, positive with the Renko chart, positive with the three-line break chart. So on a trending basis, we're positive. We're just not seeing an awful lot of conviction right now. And we declined, but we're still above the midpoint with the 150 and 200 period moving averages. No change here. Still, the mid caps and small caps are having a hard time with their 200-day moving averages. And as long as they're below that, that's why we're negative in the long term. Still positive with bonds based on price in the short term. Commodities are negative in the short term. The dollar is negative across the board. And we had tech, that's a growth area. That was the strongest area. Communication was down, but just not very much. And discretionary was down. That really didn't help things. But staples were down even more. That's what's keeping the discretionary to staples ratio holding up for the time being. And then we had the energy ETF. It had a bearish MACD crossover because we just shot up with oil. And now it's coming back down with a vengeance. And so the charts are picking that up. We did get above 6,100, but we didn't stay above 6,100 for the S&P. We got above 20,000 with the NASDAQ. We did have a BPI cross for the industrial sector down below 80, where it recently just generated a cross going above 80. And the Dow did end up dropping below 43,000. So a lot of red in here, especially with staples, industrials, utilities, real estate. But the areas that were positive are the big boxes like Google, Nvidia, Microsoft, Apple. Microsoft's still looking pretty good there. But then Amazon and Tesla ended up being down. So seeing a little bit of a disconnect here where the equal weight is not performing quite as well as the weighted version of the S&P. And we also see that here with the ratio. When this is going up, that means the weighted S&P is outperforming the equal weight S&P. And we're still above the 200-day moving average with the Dow. And we're still positive with the Elder's Impulse system for the diamonds. And we're not quite back to a golden cross with the NASDAQ. It's really hard to see because you have this S2 pivot point right here. But we are above this resistance pivot point on this one. And we're positive, though, with the Elder's Impulse system for the NASDAQ. This is the one that's crossing over positive. We're seeing a golden cross now. And the chart is looking a little bit stronger. And if we're positive on the S&P, we want the NASDAQ 100 to also perform well. Positive with the Elder's Impulse system for the Qs, improving but still negative with the momentum for the NASDAQ 100. And this I usually only show in the weekend videos. We're coming right up to the underside of this long-term trend line going back to 2009. Is that going to provide overhead resistance? Now, we've broken through that before. So there's nothing magical about this. We're just keeping an eye on this to see if it ends up meaning something. And here are the small caps. They were down 1% after going up, have to be coming back down. And when we look at the Russell 2000 small caps, just cannot get above its 200-day moving average. We came up here, fell back. We tried to come up again. Now we're falling back again. And we've gone from positive to neutral with the small caps, looking at the Elder's Impulse system. Also cannot get above the 200-day moving average with the mid caps. Still positive, though, with the Elder's Impulse system. Still above both moving averages with the Wilshire 5000 and the total U.S. stock ETF. Financial sector was down 1/3%, but still holding up fairly well. Saw a little bit of a tick down with the financials to S&P ratio, but we're still encouraged that we came down to the 200-day moving average and we've been bouncing up off of this moving average with this ratio. FANG index, all-time high. These are the big stocks. And this is what really gave some strength to the market. On Wednesday, Apple was up almost 2/3%, still dealing with its 50-day moving average. Amazon was down over 1/3%. Microsoft setting another new all-time high. Recent golden cross came out with earnings and has just been going forward ever since for the most part. Google was up 2.34%, coming back up to its 200-day moving average. Recent golden cross with Facebook or Meta, but it was down 0.5%. We could be getting ready to see a golden cross here with Nvidia. And that's the big one that everybody likes. It was up 4.33%. And Tesla got hammered after it had been having a couple of good days, but it's still above both of the moving averages. So we might see a golden cross here soon. Netflix was down, but still a pretty solid looking chart there. We are improving, getting close to a golden cross with the Dow Jones Semiconductor Index here. It was up 2.62%. This is what we want if the market's going to be positive. We're also potentially coming into a positive seasonal time when we get into the first part of July. That tends to help the NASDAQ, which could help the NASDAQ 100, which could help the semiconductors, which could also help the S&P. Not a given, but this is historically what has happened in the past. And also improving, but not quite back to a golden cross with the SMH Semiconductor ETF and coming up above the rainbow, looking a little bit better with that ratio. We're continuing to go up with the semi to Dow ratio. That's improving. And we're going up with the semi to tech ratio. Now, tech's doing well, but when semis are doing even better, this ratio goes up. And that is pretty positive for the market. And we're still going down when we look at the staples to tech ratio. That is more positive. And kind of coming down a little bit in a short-term correlation between US and world stocks, still kind of drifting after it had been slowly getting stronger with the longer-term correlation. We did go up with oil. We're back up into the mid 60s now, where we were getting a little bit closer to the lower mid 60s. Dollar continues to go down. And then we're at 2.18% with the Truflation reading. This has been going up lately, but we're still under 4.5% with the 10-year yield, and we're coming back down to the 200-day moving average. Now, it was virtually unchanged, but we're not seeing a real spike up right now. With the 10-year yield, we're continuing to look fairly good with the 10-year based on price. And we're looking good with a lot of our growth to value ratios, just not discretionary to the S&P. But the Qs to S&P, large cap growth to large cap value, they're holding up pretty well and actually improving. So we're back above the moving average with the large caps, growing up with the mid caps, and even going up with the small caps. And we're going up here with the S&P to utilities ratio. When this is going up, that means the S&P is outperforming utilities, and that is more positive for the S&P. And we're going down with the staples to S&P ratio. That means staples are underperforming, which are more defensive, and that also is positive for the S&P. All right, so no change to the overall conclusion, though. We're still positive in the short, intermediate, and long term, but we're not trending. And this is one of the bigger days for economic data in Thursday's session. We'll get initial claims and continuing claims, and that's been a pretty big deal lately. We're going to get durable goods as well as the third look at GDP. Now, if it comes in pretty much the same as what we've seen before, it'll be a non-event. But if it comes in greater or lower than expected, showing a big difference from the previous reading, then it might have an impact on the market. And then not really that influential, the advanced international trade in goods, as well as wholesale and retail inventories. And then finally, we will get pending home sales. And then anything geopolitical. So is this a calm before the storm? Since there wasn't really anything coming out of the Middle East that impacted the markets on Wednesday, is that going to change on Thursday? Or are they just huddling and regrouping before each side decides what they want to do? Here's the economic calendar. The big one of the week is going to be Friday with the core PCE report coming out. And here is, whoops, this should be down here. The red box should have been moved down one notch there. Now, we're neutral to negative with the Dow and S&P, but we're flat out positive with the NASDAQ. So possibly we're coming in to some positive seasonality near the end of June going into the first part of July. So the market has that going for it. And we're still dealing with options expiration. We have 2 more trading days there where we tend to be down more than up, going back to 1980. All right, and but then you look at just post-election years, we do see some positive seasonality as we finish out the month of June. And this also shows up in the Carson chart where we see some weakness and then a little bit of a bounce going into the latter part of the month. And this is a little bigger picture where we see a little bit of a dip here before sometimes we see a bit of a climb going into July. And this is, according to Stock Traders Almanac, NASDAQ's 12-day mid-year rally here, which often starts near the end of June and then carries off into about the middle of July. No guarantee that this will happen, but this is what has happened before. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, so we're still negative on a trending basis with the discretionary to staples ratio. We have the McClellan oscillators and summation indexes for the NYSE and S&P. They're back on the negative side now. And our oscillators, including the Copic curve, continue to be negative, but they are improving there. And then our longer-term special K chart continues to be negative, as well as the momentum for the NASDAQ 100, even though it's improving. Then the three smart money indicators, accumulation distribution did decline, but it's still positive. The Chaikin oscillator, it's still going up. But then we have the Chaikin money flow, which is now negative. And then the growth to value ratio, the golden cross that I showed earlier on between in the S&P, that is still positive. Parabolic SCR is still positive, and then the bullish percent indexes for the S&P, NASDAQ 100, and NYSE are positive. The swollen trading oscillators continuing to advance, ease of movement just barely above zero. The money flow ultimate oscillator vortex, they continue to be positive, as well as the financial sector. Then here are the pivot points, which have already been updated on the YouTube community tab, and I hope you find those helpful because you can see that they really mean something as each day plays out. No change to the overall conclusion. Positive on all time frames, but not trending. Thank you. I hope you have a really good day on Thursday, and I will talk to you in the next video.